Do you know how to take income off of your assets efficiently in retirement? This is John Camarianos, founder of Mindful Advisory, and you're watching a new edition of Capital Considered, where we're going to talk about that question. This is a chart of what we call the bucket approach. This is one method of distributing your assets to yourself, of spending your assets in retirement. You can see three buckets here. The one on the left says 0 to 2 years. The one in the middle says 3 to 10 years, and the one on the right says 10 plus years. What does all that mean? So you divide your assets into three parts. The first part, the one on the left, is the assets that you will spend over the next 2 years. And this can be 0 to 3 years. There's a lot of flexibility here, but this is the way I've set it up for this illustration. It doesn't have to be 0 to 2 years. So let's just say, for argument's sake, you've got $2 million saved for retirement in IRAs, in tax advantaged accounts. This is the way I'm thinking about this. It'll vary a little bit for taxable accounts. So 2 million bucks. Let's use the 4% rule. I think that's reasonable to use right now. So what you want to put in that yellow bucket all the way on the left is a little over $160,000, $80,000 a year. Now, we're going to spend $80,000 or 4% the first year, as the rule says, but then we're going to adjust it up for inflation the next year. We don't know what inflation is going to be. We'll just assume 3%. So that'll take it a little bit above $82,000. We'll put 162 or more, a little more than $162,000 in that bucket, and that'll be your first 2 years of spending. None of this includes Social Security. This is just the assets you've saved. About 18 months, you're going to want to move some money. When the yellow bucket starts to get really low, you're going to want to move some money from the green bucket in the middle into the yellow bucket. And you're going to want to do that over the next 5, 6, 7, 8 years. And then when the green bucket gets low, you're going to want to start moving money from the blue bucket into the green bucket, but you don't want to move that money from the blue bucket right away. So what is in these buckets? The yellow bucket has mostly cash equivalents, money market funds, ultra short-term bond funds, things like that. You can use a treasury floating rate fund as well, which I kind of like. It will not be the same as a money market in that the price will fluctuate a little bit every day. It will break the buck, as we say. The price per share will not be $1 every day, or it will not be stable to the penny every day in a treasury floating rate fund. But I think you can get a little extra yield in something like this iShares Treasury Floating Rate Fund, ticker symbol TFLO. It's yielding slightly over 3.6% right now. So 18 months comes upon you, you move a little money from the green bucket. That can go on for years, and then the green bucket is going to get depleted, but hopefully at that point, the blue bucket has grown. What's in the green bucket? Probably intermediate term bonds, something like an iShares or a Vanguard total bond index fund. So investment grade bonds, nothing fancy, nothing junky, nothing low quality. Try to resist putting REITs or utilities or higher yielding dividend stocks in this green bucket. Try to keep this bonds. By the way, if you have 2 years of money, spending money in the yellow bucket, how should the rest of the money be distributed between the green and the blue buckets? Probably 50-50. That'll keep you around 45% stocks, 55% bonds in the beginning. And I think that should work. That should work well. But back to what's in the green bucket, investment grade bonds. Second option for the green bucket is TIPS bonds, which I kind of like right now because they're trading in a way that they give you something extra above CPI, which they're built to track. So something like a 2032 TIPS bond will give you, if you hold it to maturity, and that's the big stipulation, you must hold it to maturity. If you buy it right now, it'll give you something like 2% on top of CPI, on top of inflation, backed by the full faith and credit of the U.S. Treasury, if you hold it to maturity. I think TIPS are good options for this green bucket. So blue bucket is stocks. Those are your risk assets. Refrain from putting risk assets or too many risk assets in the bond bucket, which is essentially what the green bucket is. So the blue bucket, stocks, and the question there, well, many questions there, but a big one is how much domestic and how much international. If you do a total world index fund, it's going to be 65% US, 35% international or foreign, non-US. That's just the way the global stock market shakes out right now. If you want more international, that's fine. I can sanction that. I can sanction 50 US, 50 international. International stocks look cheaper now, maybe for some good reasons. Maybe the US has the highest quality companies. It's not to say there are no high quality companies overseas. That would be a false statement, I think. But foreign stocks look cheaper right now. I think it's fine to do 50-50 if you want to in that blue bucket. So that's the way this works. You have a bucket that's short-term assets that you're spending down rather quickly over a 2-year period, the yellow bucket. You have a green bucket that's going to last you 3 to 10 years, intermediate, high-quality bonds, some tips, maybe a healthy amount of tips mixed in there. Maybe half of that bucket is tips. That green bucket can be even more than half, I think. And then the blue bucket is your risk bucket or stocks. Now, you might ask, why do this? Why not just leave your accounts the way they are and just take the 4% every year off your accounts, or 4% plus inflation after the first year? Why do it this way? And I think one answer is a psychological answer. If you have your money divided into 3 buckets like this, and you know that big blue bucket is the risk bucket, when the stock market fluctuates, when that bucket fluctuates, and you know it's just sitting there and you're not going to touch it for the next 5, 6, 7, 8, 9, 10 years, something like that, until that green bucket gets depleted, you can live with that more easily, I think. People who spend their lives saving money and building nest eggs have some psychological trouble frequently spending assets. And when they see their portfolios fluctuate, they really get nervous. And so if you segregate your risk assets into a different bucket, into a different account, I think that can help you psychologically spend what you should be allowed to spend and then let that risk money grow over time. There are never guarantees in investing. You can't say you'll put $1 in to the risk bucket and you'll find more than $1 in there after 10 years. But I think this is a reasonable way to do it. I think it improves your chances of success if you do it this way. If you're a kind of nervous investor and you're skittish about spending the money you've saved. So one approach to spending in retirement, the bucket approach, I think it's valid. I don't think it's gimmicky. I think it can serve a good psychological purpose. So John Camarianos for Capital Considered signing off. If you like this video, please click like and subscribe. Thank you for watching.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.